The other issue I have with credit funds is that you are creating also a burden when it comes to repayment, especially in something like resilience. So you're not looking at the value of the company. You're looking at their ability to repay. What we're looking in PE, we're looking at the value of the company, the potential of the company, and how can we build these companies to last, to outperform the others, to grow beyond their regional borders. So that is very important to us, to become really partners with these companies. We only invest minority shares. We never surpass the 50%. And the reason for that is we value the ownership. We value those who created this company.
Welcome to Investing in Regeneration. This podcast is about changing how we understand, plan, and finance projects so that finance becomes a driver for better decisions, not just the last step in the process. In each episode, we unpack a real deal or initiative through three lenses: understanding, planning, and financing. We explore how it came about, who worked together, and what needs to change for these innovations to become mainstream. Because the real bottleneck is not capital. It is how investments are originated, structured, and brought to bankability. Our financial systems can do more than financing change. They can help shape it. Good morning, everyone. I'm very happy to be today with Valeria Ramundo Orlando, a partner and co-founder at Green Square Ventures, which is also the founding partner of Equilibrium Climate Capital. Before we jump into it, I would like to talk also about why we're doing this podcast and the topic. This podcast is about investing in regeneration, transforming planning and finance through system thinking. I think we all know we have trespassed so many planetary boundaries, and I love the work of regeneration author like Paul Hawken that says that the root cause of global warming is a massive disconnection between each other, between people and nature, and even within nature itself. Fragmentation, pollution, and degradation caused by humans. Regenerating and reversing the climate crisis, therefore, is really about reconnecting those broken strands, that those are the real solutions as opposed to standalone techniques and technologies trying to fix the problem. And that's why in this podcast, we are looking about how we first understand, how we then plan and finance projects, and so that finance, which has a big power in the world, can act as a carrot to spark better decision and move us toward a regenerative future. So in each episode, we unpack a real initiative, a fund, investment, through those lenses: understanding, planning, and finance, so that listeners can also see how all of this came about. What were the partnerships behind? Who worked together? How has been the finance structure taking into account the type of investments we're talking about? And how could we make these changes mainstream? So that's what I'm very excited to be interviewing today, Valeria. And I'm so honored also to have her. She has more than 20 years of experience working at the nexus of finance, government, and development, and has been a recognized authority in blended finance and conservation finance. And yet in this fund, as you will hear, she has made different choices. So I am going to start with that. Valeria, it's a great honor, as I already said, to have you sharing with us about Green Square Ventures and especially the Equilibrium Climate Capital Fund. Could you share with us about this fund and that you have created, all about it? Like, what are you investing on? What economic sectors or value chains does it involve? And what do you expect this to be the impact on the real economy?
Thank you, Monica. It's really an honor and a pleasure to be invited and to talk to you. And I'm looking forward to really great conversation. So Equilibrium Climate Capital as a fund is focused on climate adaptation and resilience. The idea behind it was to look at solutions in a number of countries that would allow for infrastructure to become more resilient. The fund itself invests in mid-growth, EPC, local companies. The Fund 1 is our ASEAN fund, and we have a targeted geography of Thailand, Malaysia, Indonesia, and Singapore. The interest that we had was to look for companies that have some of the know-how, have experienced but require greater capacity to actually deliver. And what we're looking at is specifically delivering resilient infrastructure under 3 verticals. One of our vertical is infrastructure. So you're looking at transport, energy, digital, urban systems, resilient materials, EPC capabilities that are focused on extending asset life, ensuring also operational continuity and performance. So we really are looking at future-proofing infrastructure in the countries and also for supporting communities. The other vertical that we're really interested in, and I'm sure that you're going to recognize, is water resilience. So underwater resilience, we have flood defense, water efficiency, reuse, water security systems, adaptive infrastructure, supporting both industry, different types of value chains, agriculture, and also urban development. And for a long, long time, as you well know, water as a vertical and as an asset class has actually been overlooked and underplanned. And so it is an essential part of adaptation to focus on the water infrastructure in many of the countries. The third vertical, which has been very interesting and growing quite substantially, is our health resilience vertical, where we're looking at emergency medical infrastructure, healthcare facilities, cooling and air quality systems. When we're looking at adaptation and we're looking at flooding and extreme heat as 2 of the biggest challenges that many communities and many governments, as well as private industry, is facing today, we see that these 3 verticals really are complementary in terms of solving some of the issues that these countries are facing. Another part of the thing that we considered was really what is the impact that we wanted to have. Even though we are not an impact fund, we wanted to make sure that all of our investment had a positive impact on the communities and definitely on nature and biodiversity.
Yes, I was thinking by having those 3 pillars, I think you have taken a very holistic approach to improve the quality of those most vulnerable groups for climate extremes. So I've noted that you have a pillar on resilient infrastructure, so actually future-proofing the backbone of our economy, expanding life cycle, efficiencies, and so forth. Then water resilience, and which actually at all those investments, you're looking to have a water-secure economy, floods, water availability through reuse, and so forth. And health resilience, which actually I think would then ground you to see whether all the other 2 are delivering what is needed for these people to not be suffering. It's great that you are looking first and foremost for the impact on communities, but then also environment and biodiversity, because of course we know that most of the people living in vulnerability depend on healthy ecosystem, and our overall economy does, but and we forget it, but they are even more directly dependent on those. So this is great to hear. And I would like that you tell us a little bit more on that impact chain, right? Ideal theory of change of how this works through the type of investments that you are doing.
So we worked actually with Calvert Impact Capital to define clearly our theory of change. And the reason we found that necessary was also to address the lack of data that we face when we're talking about adaptation investing. And we thought that the theory of change could really support and give us grounding on the work that we're doing, what we're targeting, and also how to measure the impact that we're having in terms of climate adaptation, resilience, energy transition. As I mentioned, we are investing in mid-growth companies. So we're looking not specifically at SMEs, but definitely middle, medium-sized companies that are locally grounded, locally rooted. And by locally rooted, we're also looking at local expertise that already exist in climate resiliency. So when you're looking at the regional side of the impacts of climate, you're starting to realize that companies are already recognizing the impact that climate is having on their value chain, or natural events occurring, whether it's river floodings or flooding from excessive rainfall. and the impact that that has also on industry, on corporates, communities, also children in terms of schooling, and as we mentioned, healthcare. So investing in these mid-growth companies also supports the piece of the theory of change on strengthening local business and economies. And we're also preparing communities and countries themselves, and even from local to national governments, to address the realities of these extreme weather patterns that are growing at a very significant frequency. And so in the end, what we realize is that the true impact is not only future-proofing, but giving these communities a livable future, structuring them so in the next 20, 30 years, they're able to respond to these natural events, and they're well equipped actually to respond to them. So they're not going to suffer from them, but they're going to actually be able to continue to go by day-to-day business as always.
Thank you so much. I mean, there is so much that resonates because I think the way you are doing it and the fact that you have focus on, I would say, living and thriving communities that can bounce back from these extremes, but also thinking very much on the increasing the agency of these local actors, right? And the private and on the public side. And I couldn't agree more that by also strengthening the private sector, you're actually building capacity that can complement government's roles. But actually, when I see all these pioneering advances that take so much effort, I know there is always a great deal of motivation and a person that is doing these for a reason. And so that is why I would love that you tell us, how did you come with your co-founder to the idea and the need of creating this fund? And could you share more about your life journey? What has been your North Star that every time in a way does make you shift to new adventures?
I think initially I did not think about it as an adventure, which was really interesting because there is a path that led me to think about this fund together with our partners and the team was really a path that was very based on quantitative analysis. And while we were working at Green Square on bond structuring for sustainability and for green projects around emerging markets, we also came to recognize that a lot of the green bond issuances that had occurred since 2016, 2017 had really huge challenges in deployment of the use of proceeds. And that was also coming from the fact that there was a lack of capacity on the ground of knowledge. The workforce had not been upskilled. There had not been a focus on who's going to deliver these projects that are actually outlined in these frameworks as outlined by the Green Bond Principles. And then when you're looking at sustainability-linked bond or social bonds, the same issues kept on coming up. Having a very strong background in blended finance, so bringing all partners together, also meant that there was timing. And it's a great vehicle in certain situations and also to address specific projects or specific community needs. But when we started looking at adaptation, it was more of a moment where I started noticing that regions that I had worked in private equity about 21, 22 years ago, we were investing in the southern United States. We started realizing that those same states, those same regions, same communities were really suffering from extreme weather patterns. And after 18 to 20 months, the consequences of these extreme weather patterns were still very visible. That led me to start looking with the team at quantifying not only the frequency of these events, the occurrence, and the size of the damage that they were causing, and the size of the frequency of the above $2 billion was enormous, both in North America as well as Europe, as well as Asia. And still, we started looking at this from the quantitative perspective, meaning how many events were occurring, what was the damage left behind, and what was the impact of these events on corporate value chains, on communities, on people's livelihoods, and also that triggered really a moving out, a migration, a forced migration from the original communities. When we started modeling this, we started realizing that it was really very similar to how we would model investment targets in private equity. And that came from the fact of saying we need companies to step in and to build the resilience in these communities, to build the floodgates, to build the seawalls, to build better infrastructure, to have energy that can be on hold or continuous, whether it's microgrids, but critical energy cannot fail in a moment after a natural event because it's so fundamental both for work but also for communications. And so all these little patterns started showing that there was a need to bring the capacity and the knowledge into the companies. And serendipitously, in 2023, we started talking to Bechtel.org, which is the impact branch of Bechtel Corporation. They were looking at a really interesting project in Kochi, India, on flood mitigation by using nature-based solutions. So there was an aspect of purifying water, of making water accessible to the community, of decreasing pollution in the river, as well as providing resilience towards flooding. It clicked all the boxes, but it had a challenge in being funded. And so we started this really interesting conversation about, can the project come first or can the funding come first? And what is a solution to build resilience in communities and in countries? And we started looking at, again, the traditional PE model by investing in companies that can provide these services, that can provide the solutions, and bringing this knowledge to local companies. So they are embedded in the local economy. You're building now an ecosystem that benefits from this. And so when you ask me what led us and what led me to start thinking about this fund was we wanted to mainstream adaptation and resilience. We don't want it to be something that is challenging or hard to do. It needs to become something that every single company will build with resilience guidelines, with tools, with the technology that is needed to future-proof all asset, all infrastructure, as well as services, right? Because when you're looking also at the healthcare vertical, you're looking at a need for new service provision, new reaction time that is required because of these natural events. And so it's a very positive way of seeing this, and the fund itself, and that's why we are interested in building several funds across regions, and we're currently building our second one, is because we see that we want to really allow private capital to invest very traditionally in private equity. And we build that resilience with the support of a division that we created in ECC that is called Equilibrium Growth Accelerator. This effort is really led by Bechtel.org, which will bring in engineering skills, technical skills, to grow the capacity within each portfolio company to make sure that not only they're competitive from the bidding perspective of the projects, but they're also continuously hire new local staff and train them to be able to execute best-in-class solutions for resilience and adaptation.
It is clear, though, you didn't say it in those words, but it is clear that what you want, once you discover that these places you have been investing in the past in southern United States were hit by extreme events and how they were not recovering even within more than a year, I think that seems that trigger for you to say, well, there are other pressing needs to invest on, and you have gone on to that process until you have realized that the place to have more impact is through companies and improving their capacity to mainstream adaptation. It's funny, but working on adaptation finance, I find that many people are focusing on the financiers or the projects, but they forget the project developers, which are the bridge makers, right? Like they have to make everything work at that local scale. And with that, I would like that we move on to the upstream of the investment cycle. When we look at your first fund in Southeast Asia, could you tell us more about which roles as stakeholders played a crucial role to make it a success and to make it sustainable over time? And how do you source your investments, those companies that can be the motor of that increase in resilience?
The uniqueness of this particular fund is that we started with a partnership. It wasn't Green Square creating a fund alone. It was a Green Square having a series of conversations and bringing along partners to build the capacity, the knowledge, the understanding truly what the need and what the solutions look like. We are coming from pure finance perspective. No matter if we've worked with infrastructure and engineering on energy. I started working in 2008 with early renewable energy in the blue economy, whether it was wave regeneration, offshore wind. But having the skill set of the engineering that Bechtel provides is essential. Also, because it gives us such a huge understanding of what kind of investments we can make and what are the criteria for those investments to really be eligible to become companies delivering resilient solutions. That is something that cannot be, it's not something that we take for granted. And it's also something very unique about our fund. And then we started conversation with Calvert Capital to really understand the data metrics of how can we show what is the impact on resilience, what is the data that actually future-proofs investments, future-proofs communities and livelihoods. And they have such a huge and long experience doing both social impact in the blue economy, impact in smaller communities, that this knowledge has really enriched the way that we see and that we evaluate when we do our due diligence. Every single investment. We have different layers of due diligence for our investments, and those are all done in partnership. And again, this is very unique to our fund. So our team I love our team. It's fantastic because we bring very different and extremely compatible set of experiences, whether it's coming from the engineering EPC, or where it's coming from operations side, or from public markets and thematic investing. So we have a really deep understanding of what investors are looking for, or whether it's coming from pure public and private partnerships, blended finance vehicles, or traditional private equity. So why are we discussing this before we go into when we started looking at Southeast Asia? We had a very strong presence already. I had been working almost a decade in the region, and we had partners that had companies there for 65 years. And so the presence in ASEAN was very deep. The understanding also on how the markets work was very clear, and we were very confident. One of the most amazing things is Malaysia this year is going to be the first ASEAN country to issue a national climate adaptation plan. They've been working on it since 2023. It's gone through all legislative policy reviews, and we're looking forward to it because alignment with national climate adaptation plans or with visions of countries is fundamental, because we're coming in and we're supporting this greater idea of what resilience looks like for the countries and for the communities. And so what we did, for example, in Malaysia is we signed an MOU with the IMTGT, Joint Business Council, which is a joint business council of Indonesia, Malaysia, and Thailand Growth Triangle.
Wow.
And what they do is really, they were incorporated in 2021, and they formulate and support communities into becoming greener, but also at the core, they're also supporting business strategies, growth strategies that are leading for finance and economics of these communities and regions and states. And so this has allowed us to have an MOU with 40 different municipalities that are all reviewing and understanding what their adaptive and resilient plans are going to look like in the next 5 to 10 years. And this is extremely interesting because it allows us to really identify which portfolio companies really fit within the strategy of the governments, because you're looking now, where is the cash flow coming from? It's not only governments. There's also private industry that has cash flow that is looking at how to invest it in resilience and how to support resilience project to protect their value chain. So there's both. There's private and public money. Public money is looking at very large projects. We are looking at middle-sized companies. So they would be subsidiaries to the large projects. They will be very flexible. They can work on a multitude of projects. And that is our idea behind our investments. So when you're looking, why do I say traditional? Traditional is we are really looking at companies and wanting to be very on hands. So active managers, we want to build companies to last, for the companies themselves to be resilient. We want them to be able to continuously upskill. And even at the end of our fund life, we look for building this network of companies where we're continuously supporting each other. And so that we are structuring as a distributed platform, which means all of our portfolio investments are going to be connected to each other in one way or another, whether on the project base or also just information sharing.
I must say, I knew it was a very pioneering fund, yet it's great to see at every step how you're doing that very ambitious and audacious goal of, in the one hand, wanting to do this mainstream, and so financiers like boring, and you want to keep it that everybody could do it, and at the same time, very deliberately in the choice of the investments, taking that holistic or systemic view. I think it's also very present on this process that you have given a special value to understanding before jumping into the design and the value by having those partnerships with Bechtel on the engineering side, Calvert Capital on different economic sectors. And at the same time, I think due to the local partners you're working with, you are looking how your investments will fit into that ecosystem and how they can help spread adaptation, being middle-sized, to the larger projects that governments or companies are investing on. So you're already answering me the question on how do you sort your investments, about what's the logic, how do you choose these companies. Still, when you're looking, for example, at those three countries, how does government or regulations or the procurement setup of these countries make that you might have more or less opportunities or investees?
That's actually an excellent question. And it's something that we learned along the way as we were designing, structuring, and building this fund. What we've recognized is that there was a lot of inaccurate risk perception. And that was the first challenge. Other challenges were, well, none of the three are poor countries. They're not DAC recipients. They're not ODA. So you're looking at not development. We weren't looking for funding from development finance institutions in the first place. We are looking for private investment because there is definitely a very interesting opportunity, for example, for corporates to really expand their presence in the region. So it doesn't have to be just on the investment, but we would really like our investors to become very active also within the region and the companies as we are building this ecosystem of partners, which are not only government partners, but are also private partners. There are a number of climate labs that are looking and seeking projects and investments. So we have visibility of what of the projects pipeline looks like for each country. We also have knowledge because of our relationships of smaller projects that are occurring at community and municipal levels that are fully funded. We then have teams on the ground. We have an office in Malaysia, for example. I was living in Thailand for 3 months last year, where we're looking at specifically what are the opportunities, what are the partners, what are the companies, and really understanding the company landscape. When I say traditional PE, that's also what I mean, is having this network and connection on the ground. These are not things that are very publicly shared. So we have a deep-rooted understanding, connection, people that see what we are trying to do and are willing or interested in supporting us. So beyond government relationships with whether it's the development banks to support them when they're financing a project, we can tell them that we have the companies that can actually deliver the solutions that they're putting into their bids, which is a very important cooperation and partnership, which I wouldn't call blended finance, but it's almost the evolution
It's skills,
of what,
right?
yes, but it's the evolution of blended finance, right? We are going from having to have systemic structured mechanisms and vehicles to building those relationships and partnerships now.
Mm-hmm.
It doesn't have to be unilateral, but we're building an ecosystem.
Yes. Recently, I was in a discussion on financing water resilience for Europe, and it was said that we underestimate sometimes the power of blending skills, right? Which is maybe much more powerful than blended finance alone. So I think this is very interesting. Now we will jump. We have looked at the planning. How have you set up this fund? Why? What type of knowledge have you involved? And networks also, no? So I really like what you mentioned of a deep-rooted understanding. And from that deep-rooted understanding and setting it up and now doing the investments, could you tell us, in terms of the financing part of this fund, could you briefly describe how it's structured and why?
They say that once you work in PE, you never leave PE. I started PE more than 2 decades ago. And what you learn in private equity is the clear impact. I was doing distressed. So I was always very connected with marginalized and communities that were undergoing huge transformation. And this is not unlike communities today that are undergoing huge transformation from a climate perspective, having to basically migrate for their communities for a number of months or days because the living conditions are no longer feasible. So the region that we looked at, as I said earlier, is actually a wealthy region. We will be close to seeing Malaysia passing from emerging markets to emerged market. They have incredible natural resources. They have a great government structure. Thailand is doing extremely well, and so is Indonesia. And we can't forget that Indonesia is the 4th largest country in the world by population. And extremely rich in resource and extremely rich in culture of their people. But also ASEAN is highly exposed. If nothing is done, if resilience is not built in, they're going to lose an enormous part of their GDP by 2040, 2045. This is something that I heard a number of members of the national banks, both in Malaysia as well as Indonesia, discuss at length. And even in Bangkok during Climate Week last year, they were discussing how resilience needs to become a priority. So why do I go to this before going into the depth of PE and why we chose PE? There are a number of funds that were created at the same time that we built Equilibrium Climate Capital that are focused on credit. And whether it's public credit or private credit, it's a form that is very used in blended finance, but it's also very comfortable place, whether you're investing in bonds or whether you're investing in lending, whether it's for projects or lending to companies themselves. But one of the things that I found out working for an extensive period of time in Southeast Asia, especially when you're looking at medium-sized company, there is a lot of cultural perception towards borrowing and the credit. The other aspect, again, coming from a background in private equity, is we want to share the risk, the success, and the story with these companies. And we're not afraid to do it. We know what our skill set is. We know how we can bring the necessary, because of our Equilibrium Growth Accelerator, we know that we can bring that growth that is necessary. So we know that we can meet the valuation that is expected from us and from these companies. But you need to do it in an active way. And we believe that doing a credit fund, for example, was not fully being engaged, and we would be disconnected. The other issue I have with credit funds is that you are creating also a burden when it comes to repayment, especially in something like resilience. So you're not looking at the value of the company. You're looking at their ability to repay. What we're looking in PE, we're looking at the value of the company, the potential of the company, and how can we build these companies to last, to outperform the others, to grow beyond their regional borders. So that is very important to us, to become really partners with these companies. We only invest minority shares. We never surpass the 50%. And the reason for that is we value the ownership. We value those who created this company. We value their effort. And what we're there for is to give them a set of skills and tools to make them bigger, to make them better, and to make them essential to deliver on these government projects that are part of a national climate adaptation plan, in the example of Malaysia. But also Singapore right now is involved in a lot of resilience projects. So it's really important to create regional entities, because right now, the majority of the support is coming from Europe and North America and China when it comes to certain delivery of certain skill sets. But because of the frequency of the events globally, these companies are also booked up for years. So they're not readily available to deliver these projects. And so we've seen them winning bids, but then there were project delays because it no longer becomes a priority. So we want to make sure that it's local capacity that is built, and also local know-how, because we can scale companies, but certain solutions are very localized, and other solution can be actually applied within the region or within different context. One thing I wanted to talk about, though, with what you've just asked, is funders. You said investees and investors. What is the challenge with investors is markets. Today's markets, public markets, especially North American-based public markets, are delivering extremely high returns. And we are able, as a PE firm, with our modeling and valuation, looking at the net IRR for our investors at fund closure, we are delivering above market returns regionally. But it's really hard to beat today the capital markets in North America. And that is causing an issue for most emerging markets. So you can look at emerging markets from a very economic diversification perspective, saying, okay, I want to diversify my portfolio as an investor. Let me look at getting more investments done in EM. The issue is you still have a fiduciary obligation towards your stakeholders and your shareholders to provide them certain returns. And so this is what you're competing with as a fund. We're not, because of globalization, you're not only competing locally, but you're competing at a global scale on returns that have a very different pattern. And so that has been one of the biggest challenges, to adapt the returns to what investors are also looking for. Because if we want to mainstream resilience, energy transition, a just transition, we definitely want capital that is being moved from North America or Europe to Southeast Asia and to other regions, because they see the opportunity. When you're looking at stability, there's stability in the region. When you're looking at Southeast Asia, it's bigger than Europe in terms of population. You're looking at countries that are embracing prosperities, that are growing economically. So there's a risk perception, and there's also margins, return perspective. So we outperform the market locally. But the problem that today you can put capital anywhere. So you have to see also the long game. Why investing in Southeast Asia can be beneficial if you also want to enter that market and you see it as a really prosperous market in the future, for diversifying also your distribution, your ability to invest in the future.
So you need sources of finance and investors that have an interest in the region for other strategic purposes. Like you were mentioning, also corporates who want to increase their footprint. We're already getting into the next phase, which is a reflection on how the fund you have structured embodies some of these 8 regenerative design principles that are inspiring how nature regenerates the world day after day. And I would like to, because of what you have been telling us about the choice for you to invest in private equity, to not be at a comfortable place and create a future burden, but actually actively increase the capital in all senses of those local actors, is one of the principles most important, or all 8 are important, but there is one that is about empowered participation. And it reminds us that systemic health depends on all actors being empowered to contribute meaningfully to the whole, going beyond inclusion toward participation and shared responsibility. So yeah, I wanted to ask how these different actors, public authorities, investors, operators, and affected communities, in a way, are exerting agency in the companies and the investments you are making.
It's a fantastic question. Let's start with the team. Our team is deeply committed to resilience, whether it's because they see it from the eyes of their children, wanting to truly look at a better future, a world that is more livable, where things have been planned already to respond to these events so they're not as traumatic as they currently are today. So our team is incredibly special. They have an enormous amount of experience that is very varied. And they're bringing that in to work on very regional areas. And some of them have never focused on one specific region. And that is really interesting because this wealth of experience that they bring, and they're all multicultural. Every single one. I'm half, but every one of my team members has whether different ties to different parts of the world. And we found that that is extremely important to also understand, not only from an empathy perspective, but the cultural dynamic, to understand better what countries need and to have a new sensibility to listen. Why is listening very important from our point of view? And when you're talking about agency, is because we're not coming in with what we think is going to solve their problems. We're coming in listening to them, what they need and what their priorities are. And then we're going to look for the companies that can solve their problems, that are local partners. And we want these local partners to stay and grow beyond us. And that's how we mainstream resilience and adaptation. This concept comes from the fact that the team itself is not looking at just what are the benefits for them. We want the benefits for our investors because the investors are the most fundamental piece of this puzzle because they're bringing the capital in. So our focus is to make sure that our investors have all of the benefits that we can provide them and also gain an understanding of the geography of the needs. And as we discussed earlier, how they can contribute in different ways and participate in different ways. So that is slightly different than traditional PE, but not completely, because we have seen PE move this way, starting with one investment and then getting a second and third within a community. And all of a sudden, the local economy grows. But this is also the principles of who's managing the fund. One of the announcements that I was going to keep for the end, but I'll do it now because why not? So joining our team, we have Rolando Murillo. He's coming from 20 plus year in public sector investment. He's done emerging markets, Latin America. He's done US and Europe. And he has created some of the most incredible thematic funds that I have seen really globally. They are very truthfully geared at looking at public companies are looking at resilience. They're looking at adaptation and how they're responding. And bringing somebody with such an incredible and wealth of expertise from the public markets perspective is fantastic.
Yes.
Because he understands the global view as well as the regional view of what these companies need to become best in class, what these companies need to then become public, to then become part of portfolio. Again, we're talking about also mainstreaming capital markets with adaptation. So we're super excited to welcome Rolando as a partner into the fund. And the fact that he's joining also shows that someone with such a wealth of experience choosing to come into investing in PE has gone through his personal journey of transformation. So I'm sure that if you invite him, he will be very happy to come talk to you soon.
Oh, that would be awesome.
And about his role. But I'm mentioning him mostly because we have worked together for many years in different working groups, from UNEP FI, the Blue Economy, on fisheries, Blue Guidelines for investing. So we work together quite a while, and this is the ecosystem, is to bring in people that are starting from an investment and finance perspective. They need to diversify the way that we invest. And so when we're going back to the discussion of agency, yes, agency, we want to support communities, but we're also saying that it is an opportunity for markets to mobilize in a very healthy way, because that is where the future investments are going to be. And more and more banks, financial institutions, asset managers, and large PE shops are starting to recognize that resilience is where the new investments are going to be.
That's awesome. And I would like actually to look at that principle that is called honors community and place, right? Because with globalization, which you already told us what some of the effects are that you were experiencing, people forgot we don't experience anymore the impact of what happened around us, right? So they say in the old times when we didn't have a global economy, if you used to eat one apple a day, and then suddenly decide to eat 5 or 10 every day, you would quite quickly see around you changes in land use and would say, oh, maybe it's not that a great idea to have 10 apples a day when where I live it's changing. But with globalization, we've lost some of that connection. Now, in the way you have said of the fund, and you are getting your investors to understand these dynamic at community and a local level, seems that in a way they are starting to see these connections in those ecosystems, regions that they are working on. And so at Adaptation, it's also a certain type of investment. So I wanted to ask what aspects of the investments you do in Adaptation and for the fundamentally shaped by local context and cannot be standardized and honor that place and community. And at the same time, how do you manage to have the level of standardization needed so that capital can stream without excessive transaction costs? How do you keep that balance?
And that's an excellent question, to be honest. So for us, biodiversity, respecting our nature and biodiversity is essential. But also the original conversations that we had with Tam, who's the president of Bechtel.org, who's really a fantastic partner, we started having these conversations about how do we bring in nature-based solutions into infrastructure that is traditionally gray, blue, or gray. Because that's one of the things about adaptation. Adaptation still will require, for some time, gray infrastructure. But the future-proofing of that infrastructure comes from the nature-based solutions. But a nature-based solution might take 10 to 12 years. So as we put it in, as we train our companies to build these solutions within the projects that they're working on, that is all community-driven. Because eventually we will have to train also community leaders or smaller SMEs or smaller entrepreneurial efforts from community members to continue to maintain those nature-based solutions, to make sure that they do literally build that natural barrier, natural resilience to these events. And it's not always going to work because rapid urbanization has already had a huge impact on natural waterways, on natural land. And so you want to build nature and evolve how nature can actually support these communities. But we truly believe in biodiversity regeneration and the fact that is our greatest resilience tool that we have. Because as walls have to be rebuilt, if you allow mangroves to grow strong, they're going to build their own wall. And then you can continuously work hand in hand. But respecting nature and respecting biodiversity is one of our key fundamental principles of how we want to also instill this in our portfolio companies to make sure that this becomes something that is second nature to them. Mm-hmm. Because for too long, the focus, and also if you look at medium-sized companies, especially medium-sized companies that do great work and they have lots of work incoming, lots of projects, they're stretched so thin. They don't have enough manpower. So for them to start really assessing also, how do I include this particular solution in? It's really a challenge if there is not a time where they can learn where this is facilitated and where it's made easy, which is very important.
So I read from what you said that keeping that balance has led you to work on making those companies you're investing on first increasing their understanding and capabilities in that area so that they can do it easier at lower transaction costs for you and investors. So that's great. And now another regenerative design principle that I saw very active all through your answers and the design of the fund is the edge effect abundance, right? And that says that innovation and creativity flourish at the boundaries between systems, sectors, and disciplines, where diversity and collaboration generate new possibilities. And I was noting, because I'm this part of how do we have these three revolutions in understanding, planning, and financing. And then this word of edge effect abundance also explain why diversity is a power, right? And I think you explain it all so well, both in the way that you have set up the team so that diversity increase understanding, and both in terms of disciplines and culture, but also the way you have your three pillars. I think already shows also that you might be investing also in things that have a dual function, like they could contribute for future-proofing infrastructure systems, but at the same time, look at the health resilience aspects. I think what is great is that you seem to be helping your investors increase that understanding of these connections. And that might be driving them to invest more and more in specific regions because they know they will also capture some of these benefits, right? What I want to get to now, though, is I know you have also mentioned the partnerships that are the core of this fund. Now, looking back, what key lessons or practical advice would you share with others seeking to finance similar transformational adaptation and resilience? Companies, projects, deals?
So this is a question that gives me a moment of pause to really think about the realities of building a fund. Often funds are being portrayed as something super fast and easy to design and to build. And of course, if you're coming from a large corporate or a large bank that develops a fund like this, they have timing requirements, they had fundraising requirements, and they need to hit certain KPIs and deliver. When you are individually and in partnerships building a fund, we have built it where we are looking at having to succeed. There is no margin. We have to succeed. And that is a very different way of thinking. So it gives you also the time to really think things through. And as you mentioned at the beginning of our conversation today, there have been changes. You start with one vision and you modify it when you start recognizing what the reality is, also what the demand is. And the interesting part is that there are some times that we had to circle back where our initial interests were resurfaced as being probably the most valuable in this context. And one of the examples is that when we initially were looking at investors, we really wanted corporates to come along because we saw that they could benefit from their development, their value chain, their expansion, the connections, the getting to also look at other projects that they could execute themselves, truly becoming a significant part of this ecosystem. And we still value that. We still believe that corporates have a huge interest, and it also risk mitigates other investments that they have and other projects that they're working on. So that was one of the things that I think from the lesson learned perspective. One of the greatest strengths is having been able to work as a team with the partners and not making it about me or just the fund or just the portfolio, just the returns, but the ability to share, the ability to say, there's enough. We are in this because we want to bring in investors and maximize their return. And in order to give them the best value, to grow the companies to the correct valuation, we need these partners to execute that. And that means sharing. And this also brings me down to building local relationships. We have AMSAR in Malaysia that is fantastic. We had historical relationships in Southeast Asia that they are from the countries and they're interested in seeing their local companies growing and acquiring these skill sets and being valued and being seen and being able to actually deliver. And so, yes, some of the realities are very local, but what we have noticed is even though a specific solution is very localized to a certain particular consequence that a natural event may create, the solutions themselves can be adapted and can be expanded. So we're seeing companies that are able to deliver these solutions that can work whether in Australia, in Malaysia, in Thailand, or in the Middle East. And that is truly the strength. to build companies that have great regional and transnational value as well.
Thank you. Oh my God, there is so much to unpack on what you said. And I think as you were sharing, I can see that in your lessons and practical advice and how you have walked this path, you're embodying also more of these regenerative principles in the sense that there is that issue of in-right relationship. So how, you have diversity of partners and smaller and bigger, and they are all part of that process. And the other part is that views wealth holistically, because you're telling me you wanted to, of course, that have the returns for the investors, but you're looking at all the aspects that would make this fund a success. And especially stood with me that you said there is no margin. We have to succeed. And I think that's fair in the sense that you're working in emerging markets. I have had exchanges in the past between the Netherlands and people from the global south. And the Netherlands would say, we experience with this idea of the sun motor, and you have to risk, and sometimes work and sometimes do not work. And the developing countries would say, we don't have that margin. We cannot. We have so many limited resources. So, but that signals also that in a way, the fact that you had to succeed, you are focusing all of your efforts on a very clear mission. And so is all the efforts in mission driven, by which you then also understood that you have to put enough effort in that understanding the reality and adapting to it. And maybe, and that's more like a quite personal view, but it really starts with an idea that there is abundance, that everybody can have enough, isn't it? So then you don't have to compete and you're breaking silos. So I really love it. Thank you for sharing. And then the final question is that one in which I want you to imagine yourself with limitless power. And if you had a magic wand and could change one thing in the system to make investments in adaptation and thriving communities like this easier and more impactful, what would that be?
So I'm going to take two magic wands. The first magic wand I want to use to catalyze systemic rule change. We lack standardization of adaptation taxonomies. Everybody is creating their own. Banks are creating their own and pitching them to their investors. Funds are creating their own, because we do need a map, an investment map. And we need also an idea, whether it's an investment tree, an investment map, like with targets, what it means to invest in adaptation and so on. But the issue that there is no standardization of taxonomies, and we're not saying we need one, but at least similar ones, which would allow also for the verification project, as we mentioned, data, so that we know that if we are doing X, Y, Z of investments, they can be verified that they fall within resilience and adaptation. Because currently adaptation is invisible on the balance sheets, and capital can't scale. Because in the end, investors and corporates or banks and asset managers or fund of funds really need to quantify and qualify their investment. So one thing is if you're investing just directly into Equilibrium Climate Capital, and then we invest in a company that does services for floodgates using technology, we can fall into a very traditional infrastructure. But if we say this is a climate adaptation and resilience investment, then we need to abide by a set of standards. So magic one, number one is, can we all get together? We're not that many. So let's do it sooner than later and try to figure out how to talk to each other and come to an agreement. What is this investment map? What is a taxonomy going to look like? And make it simple. We don't need anything extraordinarily complex. And no more reporting. It's just to know that we're doing investment in adaptation for all parties involved. And this also obviously includes credit funds have the same issues. Every single investor in this space is faced with the same issue. The second wand I want to use as an investment opportunity. what that means is we see adaptation as a fiduciary risk management and also as part of being what we could call a business security agenda. Why? Adaptation future-proofs, builds resilience, and decreases the risk for community, governments, value chains, corporates. Currently, has been labeled under a culture war, has been labeled because it has the word climate. The public doesn't understand it. It has been pegged and tagged as a responsibility of national governments. And it's not only national governments, it's everyone. We all have a responsibility in creating and building greater resilience to protect our families, to protect our communities, to protect our governments, our municipality, our regional and our national governments.
It's like a civil duty, right?
Correct, because in the end, when an event occurs, the community is subjected to a trauma. And the fact is that trauma can be eliminated or minimized with the right solutions. Resilience and transition towards future-proofing community is an opportunity for investing in the well-being of that community. And if you go into the true fundamentals of finance and economics, when you invest in a community's well-being, when you create more jobs, you're creating a stronger economy. And from a capital markets perspective, you're creating opportunity and greater value. So we really have to go down to the basics. We are looking at an event that is unavoidable. We don't know the actual frequency, but we know that there is an increased frequency every single year. So we also know that by building certain solutions within infrastructure, within services, you are creating well-being, but you're also creating jobs and new skill sets.
Thank you so much. And that was not a planned question. That's still for the younger people, from everyone that is entering into this world and want to understand more financing of adaptation. Any tip you would have for where can they start?
I think the first thing is to become more aware of one's footprint. Mm-hmm. A lot of people, and I think the newer generations are starting to gain this awareness in some cases. Some governments are taking action towards the need to really understand the footprint of consumption. And then once you understand your footprint and your relationship of you to nature, to what surrounds you, you start becoming aware also of the changes that are occurring. Because you can't traumatize the new generations, and it's not fair to say, oh, these things are going to be part of your future. Of course they will be, but they need to understand how they can actually be actors, mm-hmm. and they can be part of the solution of this. And this is why starting to also work with academia, and this is something that the Equilibrium Growth Accelerator is beginning to do, to start bringing these skill sets at the academic level. And hopefully we'll also bring them at a level of high school, where really young people are starting to feel that they are part of the solution and they are succeeding at creating those very diverse solutions. Now, one of the things that we have seen is looking at young people from universities or just out of universities and the different types of technology that they're starting to explore that is very resilient driven. So those are things to look after and to see and to also support. And I say this to most governments, make sure that your young ones are being supported as they explore ways of decreasing pollution or water catching systems. They're incredibly innovative for protecting oneself from extreme heat. Those are things that are coming from individuals.
Thank you so much. So with this, I would like to end this episode and in a way saying I'm incredibly grateful that we could go through all these phases on understanding, planning and financing, and how that view on how diversity is also increasing the resilience of the investments and their impact. So thank you so much, Valeria.
Thank you.
Thank you for listening to Investing in Regeneration. But before you go, if this conversation sparked new ideas for how we understand, plan, or finance projects, I invite you to take one small step today. Leave a rating and a review. It helps this podcast reach the people who are shaping decisions. And please share this episode with a policymaker, a planner, an investor, or anyone who has the agency to influence how projects are originated, designed, and financed. This is not just about spreading a podcast. It's about joining a quiet revolution, reimagining finance, and embracing a new investment paradigm that reconnects people, nature, and the economy, and places finance at the service of life.